Okay, let's go get ahead and get started. I'm your hot with Scott Keller. Thank you for tuning in. We're going to take a look at a few quick charts, starting with the market returns of a 60/40 portfolio over time, along with their maximum drawdowns. Then we're going to look at an update for the jobs report, which was released last Friday. And finally, I have a chart on the 2-year Treasury. So let's get right into it. This first chart is a look at how diversification has not helped investors so far this year. A 60/40 portfolio of stocks and bonds so far has returned about a negative 14% return. It's actually the worst return for the 60/40 portfolio since the global financial crisis of 2008. And certainly you can see from the chart, the second worst return for a diversified portfolio in over 40 years. So I think one of the interesting things, or one of the things that I want to point out on this chart, is the blue bars are the returns of the 60/40 portfolio, but the red dashes represent the maximum drawdown of a 60/40 portfolio. And you can see there's typically quite a large difference between what the 60/40 portfolio returns for a given year and what the maximum drawdown is. On average, the maximum drawdown for the 60/40 portfolio over these 40-year period is about negative 8%. So on average, 60/40 portfolio is down 8%, while the average return is 10.34%. So just because it's been a bad year so far for the 60/40 portfolio doesn't necessarily mean it's going to end that way. And one of the reasons why it's been such a tough year for the 60/40 portfolio is interest rates have gone up a lot. And one of the reasons why interest rates have gone up a lot is because the Federal Reserve has been hiking the Fed funds benchmark interest rate. And this chart actually looks at non-farm payrolls, the monthly change in non-farm payrolls going all the way back to the start of 20 and 21. And you can see that the labor market has been hot for quite some time, averaging somewhere around 500 to 600,000 new jobs a month. The pre-COVID average was around 250,000 new jobs per month. So the Federal Reserve has been tightening or increasing interest rates to help slow down the red hot job market. And you can see now that the payrolls number is just starting to normalize. It's been coming down for almost a year, although there was a slight jump in payrolls in August. So the Fed is not quite done yet. On the next chart, this is our last chart that I have. This just shows the rate on the 2-year Treasury. 2-year Treasury hit cyclical highs last Thursday, reaching a rate of 3.5%. The 2-year Treasury heavily impacted by changes in the Fed funds rate. This is one of the primary reasons why bonds have had such a poor year, and really explains helps explain one of the poor performance of a 60/40 portfolio so far this year. So huge increases in interest rates. You can see on this chart at the start of, really at the end of 2021, 2-year Treasury rate was around 50 basis points, just around 50 basis points. And this past Thursday, it closed at 3.5 basis points, or 350 basis points, or 3.5%. So big jumps in the 2-year Treasury yield has contributed to the poor performance of a 60/40 portfolio. Coming up the week ahead, not a lot on the docket for this coming week. We have ISM Services Index comes out Wednesday. That'll be an interesting number. And that's all I got for you. Thank you so much for tuning in.